Hello.
I'm gonna
Looked around everywhere. I couldn't find somebody who was willing to put themselves out on the limb to actually talk about all this stuff. And then lo and behold, there's always Tracy. And Tracy was more than willing to put this class together and speak to all these things because he knows it very well. I always try to do Tracy justice with his background, but I can't normally do it. I always turn it over to him because his background is very impressive. You'll get it here in a second. So thank you everybody for tuning in, and Tracy will turn it over to you.
Well, thank you very much, David. I appreciate that. Damning with faint praise. Couldn't find anybody else willing to talk about it. I like that. All right. Well, my information is floating over my left shoulder here. So if you want to take just a half a minute right now, please jot it down. You may have questions. You may even have some business like doing a 1031 exchange. But if you want, you can also shoot me an email after this requesting. I've got a little packet of just 3 slides that have the same updates that we're talking about here today, rather than trying to send out the entire PowerPoint slide deck. All right, so I'm going to start sharing my screen. And because I got 3 screens, I hope that doesn't mess it up. So we'll see. There we go. Share. All right, I should be in. Bear with me here. Okay, can everybody see me okay? Or actually the PowerPoint slide should be filling up the entire screen is what I was trying to say.
yes,
That's good.
all good.
Okay, so we're gonna dive into it a little bit. I guess in terms of an introduction about myself, hang on just a second, there's actually a mess up here. My apologies. There we go. That's where I wanted to start. My bad. Okay, so contact information. There's all my contact information. Of course, Danita, everybody knows Danita V. Hill. Everybody loves Danita V. Hill. There is a phone number that I really want to draw your attention to. Right now, all across the United States, my colleagues and myself, Danita, we are absolutely swamped in terms of the phone calls and transactions, 1031s that are being done. If you get frustrated, you can't get a hold of me by email or by cell or by text or anything, you can't get a hold of Danita, call the nationwide number, the 877 number. Any exchange coordinator that answers that phone nationwide can do several things. They can answer general 1031 exchange questions. They can actually start an exchange right there on the phone with you. Or they can answer questions about a current ongoing 1031 exchange. Like maybe you need earnest money or a wire, don't know where the wire went or something like that, whatever the case might be. So please make note of our toll-free number there. So, all right. So a little bit about us, our company. The full name of us is Investment Property Exchange Services, Inc. With a big name like that, we're a mouthful. We're trying to shorten it up to just IPX1031. And it's also our website. So actually, we happen to be the largest qualified intermediary in the United States by a wide margin. Last year, we did just a smidgen under $11 billion in 1031 exchanges. In Colorado, we did just under 600 million in exchanges. And so far this year, the first quarter, January, February, March, year over year, we are up by almost 50%. So there is an outside chance that we might even approach $1 billion worth of 1031 exchanges just in Colorado. I don't know if that'll hold true, but we'll see. You know, numbers can always deceive you into believing more than you really should believe in. So we are a group of 32 of us now, attorneys and CPAs nationwide. You can think of us as a law firm or maybe an accounting firm that does nothing but 1031 exchanges. We do the regular forward exchanges. Maybe some of you might know them as Starker exchanges. That was the court case that gave birth to 1031s. We do exchanges on things other than just real estate, things like oil and gas and water rights and air rights, minerals, leases, etc. We also do exchanges that we call build to suit exchanges. In other words, in the 1031 exchange, you wanted to do construction or make improvements to the new replacement property. And I think everybody understands, but it's part of the material today, and that is personal property exchanges were repealed from the tax code. We used to be able to do exchanges on cars and trucks and equipment and boats and airplanes and franchises when somebody sold a business. Like we used to do tons of personal property exchanges for 7-Eleven nationwide, but also intellectual property, copyrights and patents. And we used to, some of our best clients for personal property exchanges used to be Microsoft, Amazon, Facebook, Oracle. They were trading the intellectual property for URL source codes, but that was eliminated from the tax code with the Tax Cuts and Jobs Act. We only can do exchanges now on a real property, real estate being the main one. So we've just created a brand new region, the mountain region, of which I still have the franchise for the states of Colorado, Wyoming, and Utah. And I just want you to know the areas that we are responsible for. This is our website. I think it's a pretty dang good website. It's very user-friendly. You can actually, under the resources tab from our homepage, you can actually immediately start a 1031 exchange online. So you can either call us, call that toll-free number, or do it online. We also have calculators that calculate your 45 and 180 days, also calculators that'll give you an approximation of what your basis and capital gains might be. I will say regarding the calculator for basis and gain, it's probably easier, more well understood if you called me up to do that. It only takes about 3 or 4 minutes, but then the client will understand it a lot better than some calculator online. We also have a knowledge center that has one-page answers to any 1031 question you could possibly have. We have very nifty little 2-minute videos on our homepage, and I think they're a great introduction to the 1031 world. Of course, all of our brochures and reference materials, and we actually do webinars through our online website. Let me just admit a few people here. Hang on. Okay. So sorry. The webinars, though, are not for CE credit. That's why I do classes here, but we do at least 2 webinars every month, one on basics and one on advanced 1031 topics. All right, so I think that's enough for introduction here to IPX. Well, I did have some information, and gee whiz, let's use it. Fidelity National Financial, the New York Stock Exchange ticker symbol is FNF. We're the largest title insurance company in the world. 1 out of every 3, that's an amazing number. 1 out of every 3 real estate transactions are run through the Fidelity companies. And of course, IPX is a part of that. We also do exchanges, and we'll close with any other title company, but of course, Fidelity is our home base. All right, so let's dive into it. That's enough introductions. Let's move forward and we'll dive into the Gallagher Amendment. Anything that I should have said or anything, Jim, DeMarie, David, anybody ready to rock and roll? All right,
Yeah.
Silence is golden.
Yeah,
Thank
just
you,
make
sir.
sure everybody's in from the waiting room, Tracy.
Yeah, so far I've seen, I think I've admitted everybody, so it'll still keep flashing at me, I hope. Sorry we couldn't get that other function to work. So here are all the different resources that I've used. By the way, if you want to see a YouTube video, you see the one that I highlighted right there in yellow? This is a very good YouTube, and I have, with their permission, actually used a great amount of that video in today's presentation. So what was the Gallagher Amendment? So it was part of a package way back in 1982. There was a sagebrush rebellion. There was a lot of not just Colorado, but California and a whole host of other states were trying to get constitutional amendments that would help protect residential property owners. And the amendment here in Colorado is named after the state senator, Dennis Gallagher, and it changed how residential real estate was appraised so that it was appraised at market value once every 2 years. And it also stated that residential property tax collections would always be less than non-residential property tax collections. So when you hear the word non-residential, you can basically think of the word commercial real estate. So how much less is residential versus non-residential? And the answer the split, the ratio is always supposed to be about 45% to 55% residential property tax collections to non-residential property tax collections. Here's another picture stating that very same thing. So the amount of property taxes collected statewide on homes always has to be lower than the amount of property taxes that were collected on non-residential property. So now let's give a better definition of non-residential. It is indeed commercial real estate, but it also includes farms and ranches, even raw land, includes businesses. It includes specifically oil and gas properties. So Gallagher made this ratio of residential to non-residential permanent, and further, it took another step. The assessment percentage for non-residential property was chiseled into granite, made permanent at 29%. And at that time in 1983, when it was finally enacted, the Gallagher Amendment was enacted, the residential property assessment was 21%. But again, it could fluctuate up or down, but the non-residential could not fluctuate. So that led to some unforeseen problems. What determines this word fluctuates for residential real estate? Well, to keep the 45-55 split intact, the assessment ratio of 21% really had no place to go except for down as property values, residential property values goes up. The assessment was driven down, and today it's at 7.2%. So again, to put that in numbers, here's what happened. Residential real estate outpaced most other forms of real estate. So that from 1983 to 1990, you saw it driven from 21% down to 15. As residential real estate continued to increase in value, the residential side, the residential assessment value has been driven from 21 down to 7.2%. So here's an actual table of all the assessment values from 1983 up until today at 7.96. Actually, it's 7.2. The table isn't quite up to date. Here is a little bit of knowledge of what this assessment rate, this 7.2% number, what does it mean? How does it get used? So you take the value of your residential real estate, you multiply it by the residential assessment rate, and that gives you the taxable value. So in other words, if your house is 350 grand, you don't pay taxes on the entire $350,000 assessed market value. You only pay taxes on 7.96% of the 350. In other words, only $27,860 of your $350,000 home get taxed. At 60 mils, that works out to be about $1,672 of assessed property taxes. So let's take a little deeper dive on the math here. So what we have at the bottom of the screen is different property classes. There's residential. It's supposed to fluctuate. Currently it's at 7.2, but look at all the other property class types: agricultural, commercial, industrial, vacant land, etc. They're frozen. They're always going to be 29%. Well, okay, let's go look at the residential math and see how this works. If you got a home that's worth 500 grand, then the residential assessment at 7.2% begins to look like the following. It's 36,000. Again, you don't pay taxes on all of your $500,000 home. You only pay taxes on, in this case, $36,000. So what are the taxes? Statewide, an average is about 60 mils. What's a mil? It's 0.06 or 6%. And so when you take 6% of 36 grand, the answer is $2,160 is the property tax revenue coming off that particular residential property. So hopefully this math makes a little more sense. I've not seen anybody else come into the room, so hopefully I'm not missing anybody. So what is the big deal? Property taxes are a local phenomenon. So in property taxes, we're talking about, if there's less of it, the state has to pick up the remaining amount. In other words, residential property values have been going up and up. So you would think that there should be more tax dollars flowing. Unfortunately, the assessment value, that 21% number back in 83, has been pushed down to today's 7.2% rate. So even though real estate has probably doubled in value, maybe more since 1983, there's less money for local municipalities for them to spend on schools, for them to spend on libraries, EMT services, police, fire. That means that the state has to pick up the slack, and they're picking up and paying more and more of the costs that should be the responsibility of local districts. How bad is this problem? What was one of the main reasons that the Gallagher Amendment ended up being repealed? Well, here's a big change between local versus state. In the early 1980s, when you look at local expenditures being generated from residential assessments, when it was at 21%, the split between local municipalities and the state of Colorado was about 54 to 50 to 46. By the time you get to 2015, the amount of money being generated by the residential property in local municipalities has shrunk to only about 34%. More than 2/3 of all the costs were being picked up to the state, and it actually got worse by the time you get to 2019. So there's another problem. Oil and gas properties, the non-residential side of this equation, started to go up in 2013, and they were actually increasing faster in value than the residential property side of the equation. That means at that time in 2013, the 7.96% rate should have gone up. Remember, it should be able to fluctuate up or down. It should have floated up to 9.13% to maintain that 45-55 split between residential and non-residential. But it didn't happen. Why? Well, it's because we voted in the Tabor Amendment in 1992. Once again, property values were pushed down. So we need to look at one more constitutional amendment that was passed. Again, the Gallagher Amendment passed in 1982. We have this split of 45-55. We have the residential assessment rate being fluctuating down and down and down from 21 down to 7.2%. And then in 92, we passed the Taxpayer Bill of Rights. You know, what is Tabor? That's an entire presentation all to itself. But basically, it prohibits tax increases without voter approval. In other words, it's supposed to help the state grow, and the general funds budget only grow at the rate of population plus the rate of inflation. Said another way, it looks like this. Gallagher and Tabor together still forced the residential assessment rate down rather than letting it go up if non-residential properties increased. So again, Gallagher plus Tabor produced another weird phenomenon. The 7.2 assessment for residential property, it can only effectively go one way, down and down and down, meaning that local municipalities were again not having enough money to fund their business, and the state of Colorado having to pick up the slack. Well, it got so bad that we actually put up an amendment called Amendment B, and it repealed the Gallagher Amendment. It was passed by a pretty decent margin, 1.7 million to 1.2, or maybe rounded up 1.3 million. And the assessment values, so this 45-55 split, the 29% fixed in stone assessment value is completely gone. So the residential, non-residential split, the assessed values 29 and today's 7.2% are blown up. I mean, so what do we get? What is there going to be? Well, the question is the following. Amendment B provided a moratorium. It was actually a completely separate Senate bill passed in 2020, Senate Bill 20-223, that said, hey, this bill, Senate Bill 223, will only come into effect if Amendment B gets passed. Well, ta-da, Amendment B did get passed. And therefore, 223 did come into effect, and now there is a moratorium. So nothing can change on the residential and non-residential assessments. The 45-55 split stays the same. The 7.2 and the 29% assessment rates stay the same. But that's only for 2021. Well, so, okay, maybe there's no reason to panic yet. But 2022 and beyond is a whole nother story. As a result of Tabor, which is still in place, there's no repeal to it, any and every tax increase for commercial or residential property always requires voter approval. So here's what I think. I think that in 2022 and beyond, you are almost certainly going to see ballot issues increasing the assessment rate of property taxes on both residential and commercial property. How will the voters decide? Totally unknown. Based on this information and the change to the Colorado property tax law, I think an astute or a canny investor is going to have to prepare for the unknown by putting aside saving extra cash in 2021 to account for two different increased costs of ownership, because guaranteed both non-residential commercial and residential property taxes are going to go up. So the first thing I'd be saving for is looking for that increased assessed value of property, and second, the increased assessment rates. So we went through both of those concepts. Here's what might happen. If residential property assessment values go up, to help fund local municipalities, then residential assessment rates may go up by 2 or 3 times or even fourfold to begin to equalize, to become comparable to non-residential property. Let's take a look at that math. So again, we're looking at residential property. Again, the moratorium states that it'll be 7.2%, but you can see all the other property types, agriculture, commercial, industrial, vacant land, the non-residential stuff, they're still frozen, at least for this year, at 29%. But as things change and voter initiatives get passed on a $500,000 residential property, if the current 7.2% goes up 2 or 3 times, so that it begins to approach the same assessment rate as commercial, which is that 29% rate, then here's what the math looks like. Now you're going to get taxed on 20% of the value of your 500,000, so that at 60 mils, this is what the math turns out to be. Remember, the old number was about 1,000 and some odd. This becomes over $6,000 in assessed property tax dollars. So this will be a big change, I think, for residential real estate. How fast will it move from 7.2 up to 20 or getting close to the 29%? Will it surpass the other 29% of non-residential property? We just don't know. The long and the short of passing Amendment B is that it repealed Gallagher, but what did we replace it with? The answer is we don't know. There's nothing out there yet. So we'll see over this next year how things get hammered out. That's it for the Gallagher amendment. I don't know how I'm doing for time. It's 11:30.
You're doing great. Did you
Okay.
want to take questions now or just want to roll into the tax stuff?
Whichever you guys would recommend. Oh, there are some cute pictures. I couldn't help myself.
Well, there's no questions in the chat box yet. That's pretty overwhelming information. I don't even know what to ask.
I think one thing that, as I sit here and look at this, I'm happy that they have a moratorium, because this is a huge change that affects everybody big time. But I think there's going to be an awful lot of voter initiatives being put onto the ballot saying, here, do you want to vote for this? Do you want to vote for that? In terms of raising the assessments and raising or increasing the residential property taxes. So let's see here. I see some comments that are in the chat room. Herb. Herb says he joined the Zoom session for snacks. Okay, that's a virtual snacking. Or how does the mill rate get set? It's usually voted on by the local municipality. Will the commercial rate still be fixed at 29%? During the moratorium year, the answer to that question is yes. Just like residential assessment at 7.2% will still be fixed for this year. Another question the chat room says, what if this creates foreclosure on people barely making it now? I do not have an answer. If they can't pay their assessed property value taxes and they're that close to the line and they go into foreclosure, I don't know of any recourse. There probably is some sort of recourse, but not that I'm aware of. And is this rate set per state or is it nationwide? No. This is only Colorado that we're talking about, Aaron. The Gallagher amendment and the repeal of it, Amendment B, are only Colorado. The Gallagher amendment set that split at 45-55. That's only us in this state. The assessed value fixed at 29% for commercial and today's 7.2% for residential, only Colorado. Other states have other ways of doing it. Okay, I think that's it. There might be one more question. I'm not sure.
A couple more.
Oh, here we go. Thank you for the great info. For a home that is the new property in a 1031 that is going to children. Oh, so we have a 1031 question. All right. My brain was going down Gallagher. New home property that are going to children. You know what? Who is asking me this question? Jason. You know what, Jason? Why don't you unmute and just ask me the question verbally? It's taking me too much time to scroll because for some reason my computer keeps fighting it.
Yeah, no problem. Can you hear me okay?
I sure can. Go ahead, fire it up.
Yeah, so the question is if, the new property being acquired in a 1031, of course, all those taxes have been deferred, by say for, like a father leaving it for his heirs. Once the new home is, passed down to heirs, say one day they want to sell the home, do they have to somehow come up with, whatever the taxes would have been from this original house they sold to this new house, or would they acquire the new house at? Kind of like their stepped up value at that time. Is that what the value of the house is to them? Does that make sense?
Yeah, Jason, it does. You have successfully completely commingled two different parts of the tax code into a confusing scenario. So it's my job to pull them apart and give you some good answers. First of all, property that's owned, owned by the parents, owned by mom or dad, right, and they pass away, and then the kids or the heirs get the property. So from a capital gains perspective, what happened to that property that the kids get? The original cost basis of the property steps up to fair market value on the date that mom and dad passed away. That means when the kids get the real estate, they have two choices. They can either sell it right then, and if they do, there's no capital gains because it was all erased with that step up in basis. Or the kids can say, we don't want to sell it. We'd like to continue to own the property, maybe rent it out or whatever. And they do that for 2, 3, 5, 7 years, whatever. So years down the road, the kids do decide finally to sell the property. They just flat out sell it. They will only have to pay capital gains taxes on the gains that they experienced because, again, all the previous gains from when mom and dad owned the property were erased a long time ago when mom and dad passed away. Now, in a 1031 exchange, if a person does a 1031 exchange and they buy their new replacement property, whatever it is, and they own it for 1, 2, 7 years, whatever, and then they decide to sell it. So then not another 1031 exchange. What will be the gains that they have to pay on that property that they sell? Well, it actually is made up of two parts. There's the old gain that was rolled over into it. That's what the 1031 exchange did. And then over the 5 or 6 or 7 years that they've owned the new to replacement property, there's the new gains. So in other words, I'm telling you, capital gains are cumulative. They don't go away until you actually sell the property. So did I successfully pull that apart? Is that enough of an answer for you, Jason, or do you want to try and recomplicate it for me?
No. That was great. I guess the only other thing I would say is, like, when the parents die, do you have to get like appraisal or something around that date, or how do they know what the value is of that date?
That's a good question. Very good mechanical question. So usually the IRS is pretty comfortable with the county assessors. You can get it right off their website, whatever the assessed value is.
Okay.
Sometimes you're talking about people that are rather wealthy. They may own several office buildings. They might own a strip shopping mall. You've added a few zeros to the equation. It might behoove the estate to actually get a full-blown appraisal rather than just using the county assessor's numbers from the website. But generally speaking, the IRS is satisfied with either one.
Got
Tracy,
it. Thank you, sir.
You betcha.
Tracy, we have a couple more questions in the chat box.
Oh, good. I see Shauna Lowell's. Would residential property taxes increase only if voters approve of tax increases? According to my understanding of how Tabor is now going to take full control, the answer would be yes. Because after this year's moratorium, there's nothing. There is no Gallagher. It's wide open. So I think the answer is yes to Shauna's question. Did I miss any other questions?
Yeah, there's one from Anita. If rate increases, could this push home values down to balance out pricing in the market?
That you would think that. I mean, that's a big drag on fair market value for property, except for one thing. We have huge pent-up demand, very low supply, very low inventory, and we have other supply shocks to the equation. Has anybody taken a look at the price of lumber? The cost of building is huge. So I don't think that increasing property assessment values is going to, it might impact property values a little bit, but the overwhelming supply shock of no inventory and high construction costs are still going to drive the market. We're still going to have a very tight, very upward bound residential market. And even the commercial side of the marketplace is doing quite well. Did that answer the question?
I think so.
One
more.
Can I insert it in there real quick?
Yeah, David.
The consumer price index on that, what you're talking about, a lot of those prices are going up, Tracy, but when it comes to the residential real estate, first off, you did bring up that, the Gallagher repeal passed, 57% in favor of. So the one thing in the future that worries me is that people will also vote in, another new tax increase on residential real estate that way. The other thing to consider is the increase in interest rates. So I think those two things in common going into the future will definitely have a impact on the cost of real estate. It'll have a downward pressure on it. It may not be tomorrow, but it'll definitely be, within the next 4 to 6 years.
I can't prognosticate that far out in the future. I barely make it to lunch, which is fast approaching us right now. That was supposed to be funny.
Yeah, you just can't see everybody laughing. Does Airbnb, not owner occupied, count as residential or non-residential?
I don't know the answer to the question. If I was forced to answer it, I would guess it would be on the non-residential side. But
it is residential property.
Pretty good at guessing. Thank you, David.
If the voters approve a property tax increase, does the residential side increase more than the commercial side until the ratios even out?
Well, I think you've given me a trick question, or they didn't mean to, but they did. There are no more ratios anymore. 45, 50, pardon. During this year, the moratorium, nothing changes. Nothing changes. But after the moratorium, there are no more ratios, no more 45, 55. And the 29% fixed assessment rate for non-residential property is no longer in effect, nor is the assessment rate, which during the moratorium year is 7.2%. It's not fixed. Do I think that residential assessments and values will be pushed upwards so that they begin to approach the commercial side of the equation. Yeah, that's why I gave the example of a fourfold increase, because the main thing that drove Amendment B was the fact that local municipalities are sucking eggs for getting money. All of the slack was having to be picked up by the state of Colorado rather than granulating down to the individual local communities. So I do think that assessed property values on residential real estate is going to be shoved up. How fast? I don't know.
Yeah. How about one more before you talk a little bit about some tax changes proposed?
Sure.
Herb asks, so the Gallagher repealed, but not Tabor, correct? Tabor's no increase. So what does Tabor stop?
Well, Tabor doesn't say no increase. What it says is that if you want an increase, you have to put it to the voters' approval. So will that keep residential assessments from going up quickly from 7 to approaching the 29% rate of commercial real estate assessment? Maybe. It's totally in the hands of the voters now, unless some other law or rule or something happens during this moratorium year. It's going to be entirely in the hands of voters. Again, I think the inclination, because of the reason that Amendment B was passed, is to try and drive up the assessment values on residential real estate, because local communities want money for their schools, for their libraries, et cetera. And the state certainly doesn't want to be stuck with that bill. They don't want to be stuck paying that tab anymore. Oh, do you see, Julie asked, do you anticipate commercial assessments to increase as well? I don't know. Again, it's all in the hands of voters. I'm not sure what's going to happen during this moratorium year in terms of any other rules or regs or anything coming out of the legislature to replace the Gallagher Amendment with some sort of mathematical formulas. I don't have a feel for commercial real estate, whether or not the assessments are going to increase. Just don't know. Sorry, I wish I had more of a crystal ball.
That's okay. We'll give you a pass on that. So no more questions in the chat box about Gallagher. If you want to move on.
Sure, I'd like to. Thank you, folks. Thanks for hanging in there, because you're going to be, I think, amazed at some of these other proposed tax changes that are coming our way. So this is the Biden-Harris administration's proposed tax changes versus what is in the current tax code now, the Tax Cuts and Jobs Act. So I chose 6 different major changes to the tax code that they are talking about. 1031s, individual income taxes, capital gains, estate, step up in basis, and the corporate income tax rate. I'm going to go pretty fast through some of these slides, and I may even skip quite a few of them in the interest of time. This part of the presentation alone is anywhere from 45 minutes to an hour. So, okay, so this is our template. All the changes that I'm talking about on the left-hand side, they're in the black column. The next column over is what the Biden-Harris administration wants to do or change. And then in the right-hand column is the current tax code, what it is right now. So that's our template as we move forward. And again, under the Tax Cuts and Jobs Act, it actually gave individuals, 85% of all taxpayers, got a reduction in taxes through the Tax Cuts and Jobs Act. It reduced corporate income taxes, personal property exchanges were eliminated, estate tax was reduced, and the exemption was actually increased. So let's take a look at what the concept is. In the Democrat primary candidate for president, Senator Saunders and Warren actually wanted a brand new type of tax called a wealth tax. In other words, no longer would they tax your wealth when you die. That's the estate tax. Instead, they wanted to tax you on your wealth while you're still alive. They proposed a 2% tax on wealth of $50 million or more, a 3% tax on wealth of $1 billion or more. So they're aiming at the uber wealthy. Biden does not want to do that. He wants to raise taxes the old-fashioned way, simply raising personal income taxes, corporate taxes, et cetera. Biden-Harris wants to raise about $2.1 trillion over the next 10 years, and for the next 10 years after that, raise about $4.3 trillion. what would these tax changes and these monies, the 4.3 trillion, be used for? Would any of it be used to pay down some of the current $27 trillion? I don't want to gloss over that number, $27 trillion of federal debt. The answer is no. They have pointedly said that they're going to spend it on approximately 11.7 trillion in new spending programs. I think that 11.7 trillion has been ratcheted back. We saw the 1.9 trillion in the American Rescue Plan. The American Jobs Plan is about 2.5 trillion, and the American Family Plan is about 2 trillion. So all added up together, it's about a $7 trillion increase. That's my assessment of it. But about a month ago, or 2 months ago, March the 1st, Senator Warren in Congress, in the Senate, introduced a wealth tax. So we are still going to try and have that wealth tax. We'll see if it passes the Senate. And so, in speaking of passing the Senate, let's talk about the following, the mechanics of how this is going to happen politically. So I'm not talking about politics. I'm not talking about right or left. I'm just trying to tell you the mechanics of how these 6 major proposed tax changes are going to come about. So all bills involving money, spending, or taxes must start in the House of Representatives. In the House, the Democrats have a comfortable margin, or some people would say it's not big enough a margin, of about 10 votes. So once the House creates or passes a bill, then they have to hand it off and send it over to the Senate. And in that chamber, they vote on it. And then the bill has to come to what they call a joint budget committee. They will choose either 6 or 12 members of the House and choose 6 or 12 senators from that chamber. And at that joint budget committee, they'll hammer out the final details and they'll send it to the president for signature. So in all these discussions about these proposed tax changes, the focus is on the Senate. Why? Because, as you probably know, on January the 5th, there was a runoff in the state of Georgia, both of which went Democrat to Ossoff and Warnock, and that makes the Senate 50-50. So in other words, it's a logjam. But if you pass changes to the tax code, it takes a 60-vote supermajority. But the Senate is at 50-50. That means that they would have to convince about 10 senators to defect and to the Democrat side and make changes to the tax code. In the current political environment, I think there's a high likelihood of a significant change to the tax code. Why? Because of a thing called budget reconciliation. By using budget reconciliation, only a simple majority, not the supermajority of 60, a simple majority of 51 is needed to pass any legislation. The Democrats would not need a single Republican vote. Where would the 51st vote come from? Vice President Harris, only in tie votes, acts as president of the Senate, and she would cast the deciding vote. So how often can you use budget reconciliation? 3 times in any 1 year. And in fact, the Senate has already used the budget reconciliation for spending for the American Rescue Plan, 1.9 trillion. By the way, it was supposed to be for COVID, but only about 5%, 100 billion, maybe 120 billion was for COVID. What was all the rest of it to be spent on? Certainly not the minimum wage. Here's a bar chart of what it was spent on, and we're not going to dive into that, but it is showing that a vast majority of the dollars has gone to teachers unions, labor unions, and state and local governments to shore up their underfunded pension plans. All right, so back to the question, and that is budget reconciliation. With budget reconciliation, they can pass major changes to the tax code without a single Republican offering up their vote for that package. Some people ask me, well, so how soon, how quick can any of this come to place? 2 schools of thought. One thinks that the changes to the tax code that we're going to talk about is going to take most of the year to be hammered out. And when they do finally pass it, that it's going to take effect next year, 2022. Other people think, hey, budget reconciliation, they can slam it through much faster than a great many people think. And in fact, they can even make it retroactive in place for this year, 2021. Now, me as an economist, that's what I used to do when I was at Credit Suisse. And after that, I did M&A work as an economist for the risk control arbitrage group with Merrill Lynch out of Hong Kong. I sort of recoil when I hear the words retroactive. It's like, that's not fair. Think of the damage that it will do. Think of the brain damage that accountants will have to go through with any changes retroactive to the tax code. So I did some research and I was surprised. In the past 27 years, retroactive changes of a major sort took place 17 times. I was flabbergasted. So, okay, moving on. Let's talk about the following. 1031 exchanges. I had to put that one first because that's near and dear to my heart because that's what I do for a living. So here's what they have just announced 1 week ago. That instead of completely eliminating Section 1031s, or instead of limiting it to people earning 400,000 or less, what they're going to do is the following. They're going to not let you do an exchange if your gain is over $500,000. If the property you're selling has a gain that's less than 500,000, then yes, you still get to use a 1031 exchange. But that $500,000 number is not very well defined at all. Is it unrealized gains or is it only recognized gains? Is it a once in a lifetime deal? Or is it a once in a year deal? Or is it $500,000 per real estate property that you sell? We just don't know. They've not bothered to define it. Let me give you another example. Suppose you sell a piece of real estate and your gain is 650 grand. Well, would they maybe define this $500,000 limit as follows? Out of 650, 500,000 of it you get to do an exchange on, but the 150,000 of excess gain above that you have to pay taxes on? We don't know. They have not bothered to tell us. So there is I would love to be able to email you folks and send you where to go on our website to send an email to Congress, your respective congressman. For 1031 selling 50 properties in one sale, would that be per home or the entire deal? Great question, George. We don't know. I wish I had an answer. That's what's sort of spooky about this administration and this particular party controlling Congress. A lot of the legislation is being moved through or crafted in committee by what I would characterize as stealth. Now, that's not a political statement. I'm just saying they're not revealing to the public at large the changes that they want to do. Maybe they think that makes sense as to how they can get the legislation passed. I don't know. All right, so let me go a little bit faster. 1031s are actually important. 1 out of 5 residential sales are driven by a 1031. 1 out of 3 commercial deals is driven by a 1031. And I'm going to skip and move on. I've got a limited amount of time. So if they get rid of or limit 1031 exchanges, the Urban Brookings Tax Policy Center and the Tax Foundation, using a dynamic cash flow model, have estimated that limiting 1031s would generate maybe $14 billion, maybe as little as $9 billion in new tax revenues. What are they going to do with these new tax revenues? Well, Biden's plan is called Mobilizing the American Talent and Heart to Create a 21st Century Caregiving and Education Workforce. It is to be spent $775 billion over 10 years on care for the elderly and for children. So the question, the bottom bullet point in the bubble, does it make sense to repeal 1031s to generate 9 to 14 billion and to turn around and spend it on 775 billion in new programs? I don't know. Maybe I think that ship sailed on November the 3rd. All right, so individual income tax rates are going to go very fast. And the point here is that they are now decided that they're only going to raise taxes on those people making 400,000 or above. That means that they would have to raise the top three marginal tax brackets. Bottom line for Colorado, the combination of state and federal taxes would be approximately 44% for the top marginal tax rate. For people in high tax states, California and Minnesota and Hawaii and New Jersey, et cetera, they could be looking at a combined marginal federal and state north of 60% for the highest marginal income tax bracket. By the way, that $400,000 number is not defined. This is part of that, I think, a stealth program of migrating the tax bill through Congress. It is 400,000, that income threshold. Is it for married filing joint? If that's how they define it, then that means anybody that's single, a single tax filer, 200,000 and above, would be part of this increased tax rate for individual income taxes. Skipping this, we got to move faster. I'm going to skip this one as well. And though I love this slide, I'm going to skip it because I want to be able to give you all the rest of it. Long-term capital gains, important because we're all invested in real estate. So, by the way, they're also going to get rid of carried interest. They're going to reinstate the AMT for corporations. They're eliminating the 20% qualified business income tax. They're going to increase the federal gas tax. And they may even add what is called a mileage tax. We'll see if that happens. So, long-term capital gains. What I'm talking about here are stocks and bonds and mutual funds. I'll get to real estate in just a moment. Right now, today, in the tax code, there are three capital gains tax rates. Zero, if you earn anywhere from 0 to 80,000. There's a couple of blinking lights in the chat room. Let me see if I can get them. Where can we see the full 1031 presentation? Well, today wasn't supposed to be a full 1031 presentation, Amy, but if you want, why don't you email me and I can send you some slides or other good information that way. Melanie asks, maybe I shouldn't work so hard now. Okie dokie. I have to work hard because I have 4 kids. But all right, so I'm talking about capital gains on stocks and bonds and mutual funds, not real estate. There are 3 capital gains, 0, 15, and 20. You can see the brackets right there. You get 0% cap gains if you earn from 0 to 80,000, et cetera. Why do we do this in the United States? Why do we make people who have a gain from selling stocks or bonds or mutual funds or even real estate, make them pay less in tax than what their income tax is? Because we want to incentivize people to take a risk and go put their money into the stock market, put it in mutual funds, invest in America, invest in, say, real estate. So therefore, we tax that gain at a lower preferred rate. A couple other things about capital gains. They are not adjusted at all for inflation. And remember, what is the source? What is the genesis for a capital gain? It's money that you earned and already pay taxes on that you then took. You didn't spend, you didn't save it, you took a risk and you put it into stocks, bonds, mutual funds, or real estate. That's why we charge, that's why we tax the actual gain at a lower rate. So what do the Biden-Harris administration want to do? They want to do the following. Oh, and before I do that, I want to note the capital gains on real estate is much different than the capital gains for stocks and bonds and mutual funds. We're about 5 minutes before the top of the hour, so I'm going to go even faster than I was. Real estate is the following. Take a look at it. You are going to have that capital gains of 15 or 20%, but you also have unrecaptured depreciation. You're also going to have, by default, Obamacare tax, the Affordable Care Act of 3.8, and the state of Colorado 4.55%, so that the total blended effective capital gains rate on real estate is 30%. All right, so what is it that they want to do? They want to make those people that are earning $1 million or more not to have them tax capital gains at 20%, but instead to tax their capital gains as ordinary income, which would be 39.6. I call it 40%, as you can see in the red. So let's take a look at this. I think it'll create a 4-tiered capital gain system. We're still going to have that 0% capital gains for anybody earning 0 up to 80 grand, single or married. Number 2, anybody earning from 80 grand up to 400,000, the capital gains is still going to be that 15% rate. Got to include state. So you're looking at 20% exposure. Bullet point number 3, if you're earning 400 grand up to $1 million, the federal capital gains is going to stay the same at 20%. You throw in the 5% to the state, and you have to throw in the 3.8%. So you're at almost 30% capital gains if you're in the income bracket for bullet point number 3. Here's where the change comes from Biden-Harris. If you're earning $1 million or more, the capital gains would be 40%. That's a huge jump. What happens is the following, that 20% federal capital gains turns into ordinary income. So if they should happen to raise the marginal rate from the old 39.6 up to something higher, then whatever that marginal rate is would become the ordinary income rate for capital gains for those people earning $1 million or more. Pause for a moment. If you earn $1 million or more, that sounds like me and you and everybody else probably were not in that category. But how do they define $1 million of earning? They don't define it. There's no, if it's married, filing joint, then that means a single person earning 500,000 would be exposed to this capital gains of being ordinary income. Maybe, we don't know. So that's it for capital gains. I've got to rush along here. Jim, am I still doing all right? I've got 4 minutes or 3 minutes by my clock. Is that okay?
Yeah, and people certainly can drop off if they need to go. We were trying to give them as much information as we can. So you take as much time as you want, Tracy.
You bet. All right, so the estate tax. Now I got to try and make a distinction here. So when you earn income, whether you're a server in a restaurant and you get tips, or you're a real estate agent or broker and you make commissions, or you go to the office and you make salary, maybe some bonus, that's earned income. That's what raising individual income tax rates are all about. Another bucket of income is you own some stocks or bonds. Maybe you got an IRA. Maybe you have some real estate, a small little real estate portfolio. That's what they call portfolio income, or some accountants call it the old-fashioned name, unearned income. Sean says, will there be a recording of this? And the answer is yes. Jim Cimino is in charge of a recording of this. Now, the third bucket here is what we're trying to focus on, and that is when you die. Everything you own, all your stocks and bonds and your house you live in and all your real estate, your baseball card collection, everything. The value of that estate used to be that if it was $5 million or less, you would not get taxed on it. Under the Tax Cuts and Jobs Act, that $5 million number was raised up to $11 million. Biden-Harris wants to drop the $11 million down to $3.5 million if you're married, and down to $1.25 if you're single. So let's just deal with that for a moment. If you are married and the value of your estate exceeds $3.5 million, then any amount above the $3.5 million threshold would now be hit with the estate tax, which, oh, by the way, he wants to raise it from 40% to 45%. So they're dropping the estate tax exclusion and raising the actual estate tax. All right, so step up in basis. Of all the things that could change in the tax code, this will have the most pernicious effect as it ripples through selling real estate, selling stocks and bonds, inheriting a house from your parents, estate planning. This will be huge.
Tracy,
Again, go ahead.
Can I take a step back? What if you have your entire estate in a trust?
So I can give an answer, but I'm not supposed to because I'm not an attorney and I don't want to give legal advice. However, if the trust is revocable, then the step up in basis will pass through. So too will the estate tax, because the asset is able to be removed. Only if the trust is irrevocable has it been removed from the estate valuation process. So that's a superficial answer, but it's the best one that I'm going to be able to give. Good enough, Dave? Please say yes. Okay.
Yes.
Thank you. All right, so step up in basis. Gotta make the marker go. There we go. The step up in basis is this. Mom and dad work hard all their lives and they own a farm or a ranch, or maybe they've built up a small business, or maybe they own a fourplex and they die, they pass away, and they pass that business, they pass the farm or the ranch or the fourplex down to the kids. Kids have two choices. When they get the real estate, they can either sell it and pay no capital gains. Why is that? Because the basis of the property steps up to fair market value on the date of mom and dad's death. In other words, it erases all the capital gains. Or the kids can say, you know what, we got this nice little business from mom and dad, we got a nice little farm, we're going to continue to own it and rent it, or keep running the business. So they can do that. Later on, years down the road, then when the kids sell it, they will only pay capital gains for the amount of time that they owned it. But what Biden-Harris wants to do is make capital gains taxes payable at the time of mom and dad's death. They want to tax unrealized gains. The reason that the step up in basis was put into the tax code was to keep the kids from being forced to sell the business, to sell the farm, to sell the fourplex, simply to pay for the capital gains taxes. So they're going to repeal, or they want to repeal, the step up in basis. Last one is corporate income tax rate. That was previously at 35%. It was dropped down under Tax Cuts and Jobs Act to 21%. Biden-Harris wants to raise it from 21 to 28%. I'm going to summarize this ever so briefly. 21 jacking it back up to 28% doesn't sound like that big of a deal, but at 28%, it will make the United States once again have a higher corporate income tax rate than the United Kingdom, Japan, Germany, Mexico, Canada. It makes us less competitive. So the idea is, if we're less competitive, corporations, big, medium-sized, small, will have an aversion to trying to want to locate here. So that's it. That's the wrap up. Not bad for speeding through it. We're only about 4 minutes past the hour. Anything else?
Well, we all know corporations don't pay taxes. It's a pass-through.
About 70 to 75% of the tax. So if a tax goes up by $1, then 75 cents of it is indeed passed through to the consumer. You pay more for the potato chips, you pay more for whatever it is. And you're right, it's about 20 to 25% is imposed actually by the corporations themselves. That's true. Dave's right. Okay, I'm done.
Well, Tracy, that was awesome. Just a couple questions, I think, in chat, but to make sure everybody knows, we will be sending out the recording in the next day or so. And Tracy, maybe Tracy, you can send me or Dave or both of us the copies, and we'll make sure of the slides or whatever you wanted to send out. We can do that too, whatever's easiest for you. And I don't know if anybody has any more questions. I don't know, Tracy, how long you want to stick around, but
I'll stick around to answer a few of them. Let's see here.
Maybe Demery would like to add something too, real quick.
Yeah, please. Sure.
No, just thanks. I see a few of my clients out there today, so thanks for being here. And Tracy, always appreciate you. And just remember, if you have any clients that have any 1031 questions, IPX is a great resource, Tracy and Danita.
Thank you. Well, I say, there's Eric. Hi, Eric. Rutherford, how are you doing, man? Good seeing your face. Anybody have any questions? I wish I had more of a definitive answer about the Gallagher Amendment being repealed by Amendment B. All I know is that we're in a safe zone for this year with the moratorium. Gosh knows what's going to happen next year and after that with being able to vote in property tax assessment increases, hamstrung by the Tabor Amendment. I just don't know. Wish I had a better answer for you. I do know, I believe, and I think Dave believes this as well, the residential assessments are going to go up because they're going to try and get more money for the localities, and they're going to try and become equal to commercial assessment values. So that means they're going to triple or probably quadruple in value or assessment rates.
Here comes.
Do you have a more pessimistic view or not? Do you have a more pessimistic view of how much residential assessment rates may go up? Maybe not. Okay. Let's see here. Awesome, Kim Block. Kim, please email me. I'm not being able to grab your email off here too fast. Do you deal with DST options? The answer is yes. Melanie asked me that. I deal with DST solutions, ozone solutions, opportunity zones, as well as upreads. Call me or email me and I can certainly talk you, your client through it. Well, I'm willing to pull the plug if everybody else is. Jim and Dave and Marie is.
Well, thank you
Sure.
very much.
Thank you.
Thank you all. We really appreciate it. You all have a great rest of the week and we will be in touch.
Hope you found it informative and not too depressing. Or maybe you wanted to know. Who knows? All right. Bye-bye. Thank you.
See ya. Bye.
Bye-bye.